Hi, guys, and welcome to a fresh new episode of our Made for YouTube series. I'm Sumaira Abidi, and we've been discussing a lot about mutual funds, the various categories, and how you, as a retail investor, can benefit from knowing more about your investment product. So, today we thought we should discuss hybrid funds a little bit because incrementally they're seeing a lot of money coming in to it every month. So probably a lot of you are looking at investing in hybrid funds if you haven't already. So let me invite Raghav Iyengar, who's a Chief Business Officer at Axis AMC, to decode this category for us a little bit. Hi, Raghav. Thanks
Hi,
very much
Sumera.
for joining in.
Good
And
afternoon. Yeah, thanks very
hybrid,
much for having. Yeah, hi, thanks very much for having me. Yes. Sorry, you were saying something.
hybrid is seeing a lot of interest. And if you look at the last few months, I mean, incrementally, the money that's coming in is now topping 10,000 crores, right? Uh,
Yes.
as a category, what is the reason behind this popularity? I mean, the basics, we know that it's a mix of equity and debt, but we've been doing equity and debt, individual schemes anyways for a long time. Uh,
Yes.
what is the reason that hybrid is now suddenly so popular? Is it incrementally adding something more to a portfolio?
Okay. I think Sumera. First of all, I think you cracked the definition straight away. The hybrid is, as you know, mixture of debt, equity. Nowadays, people put a more couple of more things also to it, like international equities. Some people put a bit of gold into it. So you have a very lot of categories around it. I think now, if you ask me, the Indian investors become intuitively quite smart. So I think every time the market tends to go up, which it has been over the last, say, 6, 7 months, especially, uh, the flows to hybrid have gone up. So they want to participate in equity. They want to keep their money in equity. They don't want to exit the equity space. But having said that, they don't want to be in a fully invested equity fund. They would rather invest in a mix of debt and equity. So I think that's a big reason. I think a lot of our MFDs, mutual fund distributors, also have been sort of talking about this category a lot because the worry that most people have, and I'm sure I have that almost every day, is that is the market going to fall? Is the market going to fall? And in some sense, this investment in such categories sort of, I won't say completely takes away the risk, but tries to minimize it.
Okay, fair enough. So
Yeah,
basically, an investor who's looking to minimize the equity risk. Am I
equity risk.
right? Okay,
Absolutely.
and
And also
within
one more category, sorry, Sumana, is that very, the first time investor categories are also being encouraged to come. So there are a lot of, as you know, a lot of new investors coming into markets today, people who have maybe bank deposits are maturing, maybe other instruments are maturing. They're looking to try and get that slightly higher return. Obviously, they're jumping straight away into an equity fund may not be the best thing to do. So they're also trying getting into, like I said, dipping your toes in the water by trying and putting money into hybrids. So broadly, these two
yeah,
categories.
Raghav, you stole my second question because I was
I'm
going to
sure.
ask you just that about who is the investor suited for. Because, depending on who you ask,
Yeah,
people are advising that an entry level investor or a first time investor probably start with, an ETF. Because that might be safer. But to my mind, an ETF would also invite the entire market risk,
market
right?
risk. Absolutely, yes.
Is the hybrid fund therefore the right choice? And should it be the core of somebody's portfolio?
I think investments that way, Sumela, are, as you know, very personal. So, my level of equity risk and your level of equity risk might be very different. So it's ideal, so of course, but this is a show we have to keep our investors informed. As you know, hybrid funds are not only one fund. They are actually two big categories. There's a conservative hybrid fund, which is more debt oriented. There is an equity hybrid fund, which is more equity oriented. So the way I look at it is that the conservative hybrid is like a debt plus. It aims to try and give you a debt plus return over a slightly longer period of time. And equity hybrid is equity minus because obviously it has to have a minimum amount of money sitting in debt instrument. So these are the two broad categories, and then of course you've got this big one in the at the bottom, which is what we call the dynamic equity category, which allows you to go between debt and equity. Now, as an investor, how does a hybrid fund? Is it a core portfolio holding? To my mind, to someone who finds it difficult to rebalance equity and debt. So the whole principle of investments is that you should be in variety of a variety of instruments, investment instruments, right? So equity, debt, gold, etc., etc. So the whole fun of the whole thing about asset allocation is that you need to be able to rebalance that at periodic intervals. Most of us find that difficult to do because typically that means that you need to get out when equity get trim some equity when your equity investments become very high, valuations become very high, and vice versa. The first part is easy to do. All of us are very happy to exit equity when they feel that the markets are high, but coming back in is where the discipline comes in. So in some sense, equity hybrid funds or hybrid funds sort of take away that challenge from an investor. So yes, for me personally, hybrid funds have been a core part of my holdings. What they complement other funds is that ideally I would put as my core maybe a hybrid fund, maybe a blue chip fund, and maybe a flexi cap fund. These three will always be a part of my core holdings. And then obviously, depending on what my needs are, I will either mix it up with debt, arbitrage, or even maybe some sectoral funds, depending on my needs over. But yes, yes, hybrid funds should be a part of your holding. But again, depends on your time horizon. So which hybrid fund, which type will depend on your investment horizon.
Hmm. Right. So within hybrid also there are six types of hybrid fund ranging
Correct.
from aggressive, conservative, balanced, dynamic. Then there's arbitrage and equity savings. So the difference, of course, being the varying levels of allocation between equity,
Absolutely.
debt, and like Raghav said, they have international exposure, etc., and so on. Uh, Raghav, why should an investor not just choose the dynamic route? I mean, why not just choose the dynamic hybrid fund, right? Because if the call is that I'm choosing a hybrid fund because my fund manager is savvier than me at rebalancing, therefore, should I not just trust the fund manager entirely to manage it dynamically?
That's a great question, Sumaya, because yes, I mean in some sense the dynamic equity fund or the dynamic hybrid fund seems to sort of cut across all types of needs. But just remember that I think that the key thing there is that if you have a longer time horizon, you have to treat your dynamic equity fund almost like a pure equity fund in terms of time horizon. So you have to allow the fund manager, it will play along on time. But if you're going to put money into a dynamic equity fund for a short term, say between 1 and 3 years, uh, you could get into a bit of a mess there because there could be a next. So again, it depends on your time horizon. So yeah, for someone like me who's inherently, I would say I like looking at my equity portfolio, I like looking at my investment portfolio, but I don't do too much to it. Yes, I would agree with you. A dynamic equity fund will be a core part of my portfolio at that time, always. But for someone who's able to rebalance things frequently, or who's got somebody to advise him, or consult him, or maybe he's someone who's watching your show regularly and he obviously has much more knowledge as compared to normally other investors, then yes, you can put a mix match of all the other six categories that you talked about, depending on your time horizon and your
Raghav, the other thing is that now SEBI has laid very strict criteria for all kinds of funds, right? So in equity, like you have a large cap fund where they say minimum
absolutely,
65% must be in large cap, and so on and so forth for every
absolutely,
equity category. Likewise, now the criteria for debt is also specified to a great extent. The
absolutely,
category that doesn't have any investing criteria remains hybrid and flexi cap. Now, flexi cap, by its very definition, is across the board, so it
across
is
the
at
board.
the fund manager's discretion. How does an investor evaluate the equity and debt portfolios in a hybrid fund, right? Because here, again, the equity portion can be managed like
Could
a
be anything.
flexi cap. The
Could be
debt
anything. Yes,
portion, for all you know, can be managed like a credit risk fund.
absolutely.
How does an investor evaluate that?
It's a again a lovely question, Sumaira, because this is one of the challenges that all of us have in the industry. When you can't, many hybrid funds are not exactly, even though the category is same, they're not really apple to apple comparisons. Because like you said, every fund house, every fund manager has his or her own style of managing that money. But largely, I think if I were to just put a simple thumb rule, a conservative hybrid fund, obviously, which is like a debt plus instrument, should be ideally uh, having most of its money in AAA and AA assets. That means it should not be having too much exposure or ideally zero exposure to anything concerning with credit. And obviously, even the equity space should be more of a large cap nature so that it gives the investor some level of stability. The returns have some stable return. But yes, when you look at the dynamic equity fund where the fund manager can practically swing on equity and on fixed income, I think each fund house has their own style of managing it. There is no one size fits all. I can only say that within the access space, our fixed income instruments are largely in the AAA and AA space because our view is that we are catering to a conservative investor. When anyone who's coming into hybrids is, in my mind, an equity minus investor, right? So he's anyway a little more. He doesn't want. Maybe he just wants to get a little more return as compared to a normal debt instrument, and he's willing to give you time for it. So I think they're getting into a credit risk or those kind of investments may be a bit problematic for the investor because he's coming with a mandate which is conservative. So they're ideally at the access space, ideally we are in the AAA and AA space in this category mostly. In fact, mostly in the AAA. But
Okay,
yeah,
and
but
yeah,
unfortunately, there is, like you rightly pointed out, there is no one size fits all here. Somebody will have to do a little bit of homework, maybe possibly look at some of the CNBC ratings, do a little bit of Google search and figure out exactly what the portfolio is doing. That's easily available today. Yes.
yeah, and the key word remains, like Raghav said, that everybody must do a little bit of homework. So, yes, while the fund manager is going to be managing your scheme to the best of their ability, it doesn't absolve the retail investor of their responsibility to, make a sensible choice at the very beginning and then follow it through during the lifetime of the investment. Um, Raghav, what about the, expenses and taxation, etc., for hybrid funds? How do they stack up?
On the expense side, obviously the arbitrage fund has a lower expense because they are mostly short-term in nature. A regular hybrid fund, Sumera, will practically be similar to an equity fund, maybe a little lower. The same rules that apply to our equity fund investments or expense ratios apply here. On tax, I think it's very clear. If a fund or a scheme has more than 65% average exposure to equity in its period in the year, it will qualify as an equity investment. So any redemption before 1 year will attract 15% capital gains tax. Anything over 1 year is 10%. But if it's less than 65%, then it qualifies for a debt taxation, which is up to 3 years is you pay income tax at the same tax rate that you pay for your other income. And beyond 3 years, of course, you get the benefit of indexation and a lower tax rate at about 20%.
Okay, you mentioned also that a lot of fund managers are now looking at international equity
Yeah.
as an investment option in hybrid funds. What's the other innovation that's possible here? I mean, international exposure. I know a lot of hybrid funds have now already dipped their toes. Is there anything else that can be added? I mean,
You have
multi-asset funds are there.
multi-asset funds. Yes, yeah, that's the one I was talking about. You could put anything. I mean, you there, SEBI formulas, you should have a minimum of three asset classes. So typically, what most fund managers have done is have obviously equity debt, and they've put in a bit of gold because gold is quite a liquid commodity, and it's obviously in some sense it also adds. See, the reason we are doing all this, Sumera, is to make sure that different asset classes behave differently in different points of time. So by trying to put three or four asset classes together, the idea is to try and give the investor a slightly better investment experience. So because as you know, equity debt largely move completely inverse of each other. Equity gold move completely inverse of each other. So in the multi-asset space, people have been thinking about international equities. Gold has been an old asset class. I think as and when new asset classes emerge and obviously there's good liquidity built around it, I think new classes will come in. Like REITs, for example, are an emerging asset class now. There's not too much liquidity amongst REITs today, but I guess as and when that asset class becomes bigger, I'm sure many fund managers will think about that too. In which case, then you will have the big four. You'll have equity, debt, gold, and real estate. So in some sense, like a sort of a mother of your investment portfolios. Everything.
Yeah, and Indians love their gold
Everyone
and
love
real
it.
estate anyway, right?
And you,
So, okay. The whole idea behind a hybrid fund also is one is like you said, it's meant for an equity minus investor. But the whole idea is also a little bit of diversification, right? Because you're not just tied up to one asset class. But I know investors who have perhaps two hybrid funds, three hybrid funds. Is that over diversification? I mean, you mentioned that a hybrid would do well with, say, a large cap or a flexi cap fund. Is that
yeah.
the right way to approach it, or you spread out your risk between, say,
Uh,
the hybrid funds of three AMCs?
Again, it's as you rightly pointed out, Sumaya, this is the only asset class where there is no limitation to the fund manager. Like in the equity portion, somebody can go and buy as much of small cap or large cap. There's unlike some of our other equity funds where there's a minimum stipulation of uh, let's say large cap or mid cap or small cap here, and the same thing happens in the debt space. So unless there is a very different philosophy of investment, uh, and this happens a lot, especially in the equity, dynamic equity category, because everyone has a slightly different model of adjusting their equity allocation. Uh, at Access AMC, we use the price to earnings, we use the directional market, we use liquidity. These are parameters. Somebody else uses price to book. The third person will look at momentum. So within the dynamic equity space or the balanced advantage space, it makes sense to have maybe three, four people uh, because the models will be very, very different and hence can give you a slightly better investment experience. On equity hybrid, which is the equity minus category, I think just a couple of schemes will be fine. There's really not much to choose from. It's more the fund manager's equity style which an investor should like or dislike. So some people like, I think some people like the growth style of investing. Some people like a value style of investing. Uh, Maybe if a fund is positioned in a particular space there, that could be a reason for diversification. But otherwise, likely, like you rightly said, there's nothing much to choose. In the conservative hybrid space, which is the debt space, the debt plus category space, I would go with investments which are largely on the AAA and AA side, rather than as you pointed out on the credit risk side. So these are the three broad ideas that I could think about why somebody should think of diversifying within the category.
You raise an important point about the investing style of fund managers. And, for example, say Axis has the growth bent, right? Uh,
Right.
would it be fair to assume then that the hybrid fund would also be managed in the similar style? And therefore, the question is that, I mean, one is that we sell hybrid funds saying that it's a fund for all seasons. But we know that, there are cycles when growth stocks don't perform, or where there are cycles when value stocks may not perform, right? Therefore, should investors also use that lens when they look at the performance of their hybrid fund?
Yes, they should. Absolutely yes, because there every as you rightly said, there is it's the return styles are cyclical. Uh, Growth has worked in India for a very long period of time. Our view is it will continue to work because India is a growth market. I mean, the reason why especially FIs or foreigners tend to put money into India is because they see India having much higher levels of growth compared to other nations. But yes, there will be periods of time where value tends to do well. There will be periods of time when momentum tends to do well. So yes, and broadly, you're absolutely right, Sumit. I mean, if your fund house is a certain philosophy in terms of equity, that will translate across all the equity offerings, whether it's in the equity space or in the hybrid space. I mean, very rarely will you find a difference between somebody's equity style and his hybrid style in terms of the equity part of it.
Okay, so that's another criteria that those who are watching
You can think
should
about. Yes,
keep in mind. That
yes,
I mean, don't judge a fund's performance on a short-term basis. Even a hybrid fund needs time to perform.
yes.
Raghav, thank you very, very much for joining in to explain the nuances of hybrid funds, and we look forward to inviting you again. And I hope you'll indulge us.
Thank you. Definitely, Sumit. Thank you very much for having me on the show. Thank you very much.
Thanks, Raghav. Take care. And thank you very much, everyone, for watching. I hope this video has been helpful. And if you have any suggestions or comments, we look forward to hearing them. If you have questions too, we look forward to answering all of them. Thank you very much for watching. Stay safe.